Imagine waking up one morning to the sound of shuttered bank doors, trembling stock charts, and the eerie hush of an economy in the throes of collapse. That day isn't a dystopian dream. It happened in 1929. It happened again in 2008. And now, the echoes of those cracks are growing louder than ever. The last time this happened, the foundations of America's financial system shook so hard, entire lives were uprooted. Businesses vanished, jobs disappeared, savings vanished like mist, and yet, somehow, life clawed back. Now some are saying that once more the US economy teeters on the brink. Could we be staring down another collapse? Brace yourself, because what you're about to hear isn't just history. It's a warning, it's a story of survival, and it might just be the story of your lifetime. When we think about economic collapse, we often picture sudden crashes, the stock market's free fall, banks closing overnight. But the truth is, most collapses build slowly, quietly, in the shadows. Like a cliff edge eroded grain by grain until one final step sends everything tumbling. Take the period leading up to 1929. The Roaring Twenties were a dazzling illusion. Jazz filled the air, skyscrapers pierced the skyline, and the average American believed prosperity would never end. Stock ownership became a national obsession, and ordinary families borrowed heavily to get in on the action. But behind the glitter, wage growth was stagnant, agricultural prices were collapsing, and international trade was weakening after World War I. When the bubble burst, it didn't just take down investors, it took down farmers, shopkeepers, factory workers. The economy's interconnectedness meant that one sector's fall dragged all others into the pit. Now think about the 1970s stagflation crisis, a collapse of a different flavor. Oil prices quadrupled overnight due to OPEC's embargo. Inflation soared while economic growth slowed, a nightmare combination that shattered the idea that recessions and inflation couldn't coexist. Gas lines stretched for blocks, mortgage rates hit double digits, and businesses were forced to lay off workers in droves. It taught America that global events, wars, embargoes, political standoffs, can ignite economic chaos even without a Wall Street crash. Fast forward to 2000 and the dot-com bubble. The internet had just begun to transform society, and investors believed every tech startup was destined to be the next Microsoft. Money poured into unprofitable companies with nothing but a website and an idea. Stock prices skyrocketed until reality set in. Within months, trillions of dollars vanished from the market. Retirement accounts were slashed in half, and the NASDAQ lost nearly 80% of its value. Once again, greed, speculation, and blind optimism paved the road to ruin. By the time 2008 rolled around, we thought we'd learned. But the housing bubble proved otherwise. The real tragedy wasn't just in the charts, it was in the families who came home to eviction notices, the workers who lost not just jobs but careers, and the retirees who saw their savings vaporize overnight. The last time mortgage default rates looked this bad, the US nearly fell into another Great Depression. It took years and trillions in government intervention to rebuild confidence. And now, we see unsettling parallels. Household debt in America has surpassed pre-2008 levels, with credit card balances hitting all-time highs. Auto loans and student loans have ballooned, creating pressure points that could burst with a single economic shock. Corporate debt, especially from companies rated just above junk, is staggering. If interest rates rise further or revenue slows, defaults could ripple through the system. Inflation, though cooled from its peak, still eats into wages, and the cost of essentials like housing, healthcare, and groceries remains painfully high. This isn't just numbers, it's real life. It's parents skipping meals so their kids can eat. It's young families postponing home ownership indefinitely. It's businesses laying off staff not because they're failing, but because the cost of staying open keeps climbing. Global tensions add more fuel to the fire. Trade disputes, wars, sanctions, and cyber attacks can disrupt supply chains instantly. We've already seen how a single event, like a cargo ship blocking the Suez Canal, can send shockwaves through the economy. Now imagine multiple shocks colliding at once. That's the nightmare scenario economists warn about. Then there's the psychology of collapse, one of the most dangerous forces in economics. Markets and economies run not just on money, but on trust. The moment people believe the system is unsafe, panic becomes a self-fulfilling prophecy. In 1930, banks failed in part because customers rushed to withdraw cash, causing the very failures they feared. In 2008, investors sold off assets en masse, driving prices down so fast that even healthy companies were dragged under. Today, with social media, fear spreads in seconds. One viral post about a bank in trouble can spark a digital bank run before regulators even wake up. Technology has made financial panic faster and more contagious than ever before. And yet, history also tells us something hopeful. Every collapse has survivors. Some people even thrive. They're the ones who diversify their investments, stay liquid, and adapt quickly. They don't assume the good times will last forever, but they also don't freeze in fear when the storm hits. They move. Governments and central banks, too, have more tools than they once did. In the Great Depression, the Federal Reserve barely acted. Today, they can inject liquidity overnight, buy back bonds, and guarantee deposits. That doesn't guarantee safety, but it does buy time. And time, in a crisis, is everything. Still, here's the truth that makes this moment feel so precarious. The US economy has been living on borrowed time and borrowed money for decades. Debt, speculation, and inequality create a fragile structure that only looks stable until the first cracks appear. And when those cracks form, the fall can be faster than anyone expects. The last time we saw conditions like this, high debt, inflated asset prices, geopolitical instability, the fallout was brutal. Millions lost jobs, millions lost homes, and millions lost faith in the idea that tomorrow would be better than today. That's why this isn't just an economic story. It's a human story. It's about protecting your family, your community, your future. It's about understanding that history doesn't repeat exactly, but it does rhyme. And right now, the rhyme is chillingly familiar. Looking even closer, consumer spending is starting to whimper. July's job growth hit a slump, just 73,000 new jobs, amid major downward revisions to prior months. Durable goods expenditures dropped by $40 billion since April, and Americans are cutting back on services. Economists describe the job market as stall speed, dangerous proximity to stall that could tip into slide. Worse still, economists like Sava Savary are sounding alarms over stagflation, a toxic cocktail of rising inflation, slowing growth, and a weaker dollar with a steepening yield curve that crushes refinancing hopes. The cost of everyday life remains stubbornly high, while key sectors like manufacturing, retail, and construction slide into job losses. The economy is showing signs of dependency on the ultra-rich and a handful of high-performing firms, while the middle class falters under strain, piecing it together. The US economy isn't just at risk, it's threading through multiple fault lines: debt that's out of control, asset bubbles threatening to burst, inflation and growth stuck in a deadly dance, consumer strength crumbling, noisy optimism around AI that may not translate to real resilience, trade tensions that could cut the economy's lifeline. So ask yourself, if the last time this happened ended in collapse, what will you do differently this time? Because hoping it won't happen isn't a strategy. Preparing for it is. The last time the US economy collapsed, the world plunged into months, years, even decades of hardship. But from that darkness, a new system rose. From the ashes of 1929 came safeguards that endure. From the wreckage of 2008 came reforms that stabilized global finance. Now, as we stare into risk again, we face a choice. Will we succumb to fear, or will we respond with wisdom? If today's tremors are signs of a coming quake, the truth is this: the future doesn't have to be disaster. It can be redemption. It depends on the choices we make, the lessons we heed, and the readiness to rebuild.